Hey everyone, welcome back to my PrimeXBT leverage trading series. I've been using PrimeXBT for about a year now and I am enjoying it. They just recently added a bunch of new altcoin pairings, so I have really been enjoying trading Solana on there. If you haven't tried it, make sure to check it out. There is a link down below and you can get a 50% BTC deposit bonus on your deposit up to a certain amount. Again, the details are below. So today's topic, we're going to talk about how much leverage to use. I get asked that question a lot. How much leverage did you use on that trade, Gunnar? And really, I want to bring across the point that the leverage isn't really the most important factor of leverage trading. It's more so position sizing and risk management. So let's go ahead. We'll get right into this video and I hope you enjoy. First thing I want you to understand is the difference between cross margin and isolated margin. So if you're using cross margin, you're going to be risking the whole account value. And what that means is if you have a $10,000 account and you've moved all your funds into the margin trading account on PrimeXBT, you're going to be risking that whole $10,000 with any position. Now, of course, you can use a stop loss, which I would always recommend, but the whole account balance is at risk. And if your position starts going negative, it's going to eat up equity from that rest of your balance. So if let's say you have a $10,000 account and you only open a $1,000 position, well, you can actually eat into the equity of your total account balance and the whole balance can be at risk. Whereas isolated margin, you're only going to risk whatever you're using for that position. Okay, so if I have a $10,000 account and I'm trading isolated margin and I open a $1,000 isolated position and it gets liquidated, it's just liquidating that $1,000 and the other $9,000 in my account is safe. With isolated margin, you can also use stop losses and you're obviously going to reduce your risk that way. So the next thing would be the actual leverage you're using. If you're using cross leverage, you're going to be using 100x leverage. So let's talk about that first, and then we'll talk about isolated margin, which is what a lot of you use on other exchanges. So I really want to make sure that we touch on both so that this can be a very well-rounded educational piece. So for cross leverage, you're going to see your balance here, and any reward is also going to show up there if you get a deposit bonus. And then, of course, your equity, unrealized P&L, used margin, that's all going to be right here. And what you're going to notice is the available margin percentage. And if that available margin percentage gets down to 0 or negative, you're actually going to get liquidated on your account. So you want to avoid that at all costs. And you can see here, if I just enter a $51 margin position, it's going to be less than 1% of my available margin percentage used. So if I wasn't using a stop loss, that position would have to go very, 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 very deep negative for me to take a full account liquidation on this. So since you're using cross margin in this scenario, you want to make sure you're managing your risk through position sizes. So yes, that is going to be a 100x leverage position that's open, but it's only $51. So for me personally, I don't like to use more than 10% of my full equity. Again, we really want to try to monitor our risk. And so if I want to use larger position sizes, I'm going to want to build my account larger. So as my account grows, I can use larger position sizes. I can take larger positions. But until then, I'm going to be using 5% of my equity as I build that up. So for isolated margin, this is where leverage kind of comes into play. Where you get to decide your leverage. Now, if you're using higher leverage, you're going to pay a higher fee and your liquidation price is going to be closer. So let's just say Bitcoin is at $60,000 right now and you take a 5x leverage long. Your liquidation price is going to be probably at like $30,000 or something like that, maybe even lower. All right, I don't have time to do the math in my head right now. Your liquidation price is going to be very, very low. You're not going to have to worry about getting liquidated unless there's some crazy kind of flash crash. But again, I always recommend using some sort of a stop loss. If you use 100x leverage, your liquidation level is going to be at like 59,700. So your liquidation price is going to be very close, much higher risk of you getting liquidated on that position if you don't have a stop loss because of the small move required to actually liquidate your position. Now, again, you're only going to be liquidated on that position on the amount that you opened. Now, when using isolated margin, you really should only focus on the total margin size or the total contracts opened. So if you use a $10,000 position at 10x leverage, that's going to be a $100,000 position size. If you use a $1,000 position at 100x leverage, that would be a $100,000 position size. If you use $10,000 position size with 5x leverage, it's going to be a $50,000 position size, et cetera, et cetera, et cetera, et cetera, right? So now how I would manage that is if I have, the same size leverage account on isolated with a $10,000 account, now I'm just going to use smaller positions. So I might use a $5,000 position at 10x leverage, which is going to be $50,000 total position size. And then what I'm going to do is set my risk for like $200, which is going to be 2% of my total account being risked. So I'm risking $200 total on that trade. My total account balance right now is $10,000. Therefore, $200 equals 2% risk. I really hope this helped answer your questions about leverage trading. As you can see, the leverage really is irrelevant. It's more about position sizing, overall account size, and risk management. If you are getting stopped out a lot on your positions, you're very likely using too high of leverage because if you're using 100x leverage, 50x leverage, you need to be much more precise in your entries. And also, those high leverage entries are more suited for lower time frames. So if you're trading lower time frames, quick scalp trades, quick in and outs, you may be able to get away with high leverage. But if you're trading on a daily time frame, a 4-hour time frame, you're gonna have a lot harder time getting into consistent high leverage positions and holding on to them for very long without getting stopped out or liquidated. So if you're using higher time frames, I think it's best, of course, non-financial advice, is to lower the leverage down, widen the stop loss, or on a cross margin account, use smaller positions, lower account equity, and if it goes against you a little bit, you're going to be fine because you're just going to be slowly increasing your account equity down to that 5 or 10% that you would like to use. So next time somebody asks me, what leverage did you use on a trade? I can send them to this video. I really hope that you guys learned something from it and I helped clear up some of those questions you had. Thanks again, everyone, for watching. I really hope you enjoyed this video. If you did, please give it a thumbs up. Drop a comment below if there's any other topics you'd like to see, and stay tuned for our next video, and I will catch you guys later.